Corporate Autopsy, Enron. How innovation became the perfect cover for fraud. October 16, 2001. Enron CEO Jeffrey Skilling is on a conference call with Wall Street analysts. One asks, "Can you provide a balance sheet along with your earnings statements?" Skilling: "Well, thank you very much. We appreciate that, asshole." He hangs up. 6 weeks later, Enron filed for bankruptcy. $60 billion in shareholder value vanished. 20,000 employees lost their jobs and retirement savings. One of the big 5 accounting firms collapsed. This is the corporate autopsy of Enron and what Skilling was hiding. Part 1. What Enron became. In 1985, 2 natural gas pipeline companies merged, creating Enron. For years, it transported gas, boring, stable, profitable. Then came deregulation. The 1990s opened energy markets to competition. Jeffrey Skilling, who joined in 1990, saw an opportunity. He convinced the board to transform Enron entirely. It wouldn't just move energy, it would trade it. Enron created futures markets for electricity, natural gas, broadband capacity, and weather derivatives. Wall Street loved it. Enron was no longer a utility. It was a financial trading platform that happened to own pipelines. By 2000, the stock hit $90 a share. Fortune magazine named them America's most innovative company for 6 consecutive years. Revenue appeared to be exploding, but almost none of it was real. The mechanism behind this would define corporate fraud for a generation. Part 2. The Accounting Engine. In 1992, Skilling got approval to use mark-to-market accounting for Enron's trading business. Normal companies record revenue when cash arrives. With mark-to-market, Enron could record the entire projected value of a contract the day it was signed. Sign a 20-year energy deal? Book 20 years of profit immediately. This was legal, but only if projections were honest. Enron's weren't. A contract worth $10 million that Enron claimed would generate $50 million meant booking $50 million in profit on day 1. No cash changed hands, just assumptions, always optimistic. Every deal pumped quarterly earnings. Executives hit targets. Stock options multiplied. Wall Street cheered. But when contracts underperformed or collapsed, Enron faced billions in actual losses. Admitting losses would crater the stock. So they built a system to make them disappear. That system had a name. Part 3. The Disappearing Act. Enron created thousands of special purpose entities, SPEs. These were separate companies on paper, often controlled by Enron executives. Real example, Enron's failing power plant in India, Dabhol, was bleeding money. Instead of reporting losses, Enron created an SPE, sold the asset to it at an inflated price, and booked a profit. The loss moved off Enron's balance sheet. The SPE held the debt, but it didn't appear in Enron's financial statements. Investors saw profits, losses were hidden. By 2001, Enron had over 3,000 SPEs. Some were managed by CFO Andrew Fastow. He created SPEs, moved Enron's worst assets into them, and personally earned over $30 million managing them. Perfect incentive to keep hiding problems. Overseeing this, Arthur Andersen. They audited Enron annually and knew about the SPEs. They signed off anyway. Andersen earned over $50 million from Enron, half auditing, half consulting. The conflict was obvious, but someone was about to ask questions. One of them worked inside the company. Part 4. The Warning Signs. In March 2001, Fortune reporter Bethany McLean published, "Is Enron overpriced?" she asked. "How exactly does Enron make money?" Executives struggled to answer. Analysts pressed harder. Skilling called one an asshole. Internally, VP Sharon Watkins discovered suspicious SPE transactions. In August, she sent an anonymous memo to Chairman Kenneth Lay. "I am incredibly nervous that we will implode in a wave of accounting scandals." Lay ordered an internal investigation and hired law firm Vinson & Elkins. But Vinson & Elkins had helped create many SPEs. They found no wrongdoing. Lay dismissed Watkins's concerns. 2 months later, everything unraveled. The timing couldn't have been worse. Part 5. The Collapse. October 16, 2001. Enron announced a $618 million loss and $1.2 billion reduction in shareholder equity. They were unwinding SPE deals. The market panicked. The SEC opened an investigation. Credit agencies reviewed Enron's debt. Stock dropped from $90 to $30 in weeks. Many SPEs had clauses tied to Enron's credit rating. If the rating dropped, SPEs could demand immediate repayment. That clause became critical. November 8th, Enron admitted overstating profits by $586 million over 4 years. Trading partners stopped doing business. Credit agencies downgraded to junk. SPEs triggered repayment clauses. Enron owed billions. It didn't have the cash. The stock hit $1. December 2, 2001, Enron filed for Chapter 11 bankruptcy, the largest in U.S. history at the time. Final market cap, $400 million. 1 year earlier, $63 billion. The damage spread beyond Enron. Part 6. The Aftermath. 20,000 Enron employees lost their jobs. Many had invested entire retirement accounts in Enron stock. Those savings evaporated. Investors lost over $60 billion. Andrew Fastow pleaded guilty to fraud and served 6 years. Jeffrey Skilling was convicted of fraud and insider trading, sentenced to 24 years, later reduced to 14. Kenneth Lay was convicted, but died before sentencing. Arthur Andersen shredded thousands of Enron documents when the SEC investigation began. They were convicted of obstruction of justice in 2002, overturned on appeal. Clients abandoned immediately anyway. Arthur Andersen dissolved. 85,000 employees lost their jobs. One of the Big Five ceased to exist. Congress responded with Sarbanes-Oxley in 2002, imposing strict requirements on corporate accounting, auditor independence, and executive certification. Enron rewrote the rules for corporate America. What it revealed still matters. Autopsy conclusion. Enron collapsed because complexity became a weapon. Mark-to-market accounting wasn't inherently fraudulent. Enron used it to book profits that didn't exist. SPEs weren't illegal. Enron used them to hide billions in losses. External audits weren't optional. Arthur Andersen had too much to lose by telling the truth. The fraud succeeded because it was wrapped in legitimacy. Every quarter, auditors signed off. Every year, awards were given. Every call, Wall Street applauded, until someone asked, "How do you actually make money?" They didn't. Enron's lesson. When profits depend on unverifiable assumptions and losses disappear into unexplainable structures, the numbers aren't complicated, they're lies. You can innovate your business model, you can transform an industry, but you cannot trade your way out of reality. Eventually, the bill comes due. This has been Corporate Autopsy.